Today we are going to talk about the tax implications of corporate tax systems. Imagine you are the shareholder of a corporation. Under the separation principle, corporate profits are first taxed on the level of the corporation. If the profits are distributed, you as the shareholder are liable to tax on the dividends. Thus, the corporation's profits are taxed for the second time. Countries can decide to implement different systems of corporate taxation. They can be classified into the classical system, double taxation reducing and double taxation avoiding systems. In this video we are going to talk about corporate tax systems that avoid double taxation at the shareholder level, namely the full imputation system, and the dividend exemption system. Under a full imputation system, profits are first taxed with corporate income tax at the corporate level. At the shareholder level, the distributed profits are taxed as dividend income. In general, the progressive income tax rate applies to the distributed dividends grossed up with an imputation credit. In case of a full imputation system, the imputation credit equals the corporate income tax paid by the corporation. Thus, the taxable income of the shareholder equals the pre-tax profits of the corporation. To avoid double taxation, you as the shareholder can then credit the corporate income tax on the distributed profits against your personal income tax on the dividend income. In case your personal income tax rate is higher than the corporate income tax rate, the exceeding personal income tax is levied in addition. In contrast, if your personal income tax rate is lower than the corporate income tax rate, you receive a reimbursement. Thus, in any case, the overall tax burden of the corporate investment is determined by your personal income tax. Alternatively, countries can apply a dividend exemption system. Under this system, profits are taxed with corporate income tax at the corporate level. At the shareholder level, the received dividends are fully exempt from the personal income tax base. Consequently, the corporate income tax is decisive for the overall tax burden of the investment. To sum up, both the full imputation and the dividend exemption system avoid double taxation of distributed corporate profits. While under the full imputation system the personal income tax determines the ultimate tax burden, under the dividend exemption system, the corporate income tax rate is decisive. Apart from implementing double taxation avoiding systems, countries could also apply a classical system or systems to reduce double taxation of corporate profits. The concepts of these corporate tax systems are discussed in separate videos.